Hi, this is Dominic Capolongo. I'm the Chief Revenue Officer for LiquidX. I'm here with you tonight at the 4th annual rooftop event that we hold here in New York City. It's a beautiful evening. It's an opportunity for folks from around the industry to gather with each other, spend some relaxing time with a few drinks in hand under the evening sky here in New York City.
So when we look at ecosystems and partnerships as it relates to, for example, Broadridge and LiquidX, I think the three key areas where there's benefits both ways are when there's long-standing client relationships at the Broadridge level that Broadridge has had.
There's a unique opportunity, and that comes at the convergence of the collaboration between banks and fintechs and supply chain finance platforms. I think banks and fintechs can collaborate in a kind of a unique ecosystem, each bringing something to the table. Banks, obviously, their corporate relationships, balance sheet and funding capabilities, while the fintechs like LiquidX can really deliver on providing digital solutions, right? That's both the digitization of assets, as well as for onboarding and execution. Data-driven solutions to assess the creditworthiness of companies in these markets.
Broadridge has a investment interest in LiquidX. It has for several years. Broadridge is a investor, partner. Broadridge and LiquidX actually partner. And if you take asset managers or you take areas where, let's say, operations and services needed, so LiquidX provides the workflow and the technology, and if you're a new asset manager, a new hedge fund, and you need a couple of service or ops teams, Broadridge can step in and help on that, and they have. I think that's one example. I think there's many more as we continue to move forward, as we start looking at larger financial institutions.
So it's a paradigm shift. When you consider the types of programs that a lot of regional banks our size and smaller or even larger have been working on over the years before the advent and the infusion of technology like LiquidX's technology, we were relegated to really small programs with one seller, maybe one account debtor, a handful of invoices. What LiquidX's technology has allowed us to do is grow in an economy of scale that's a magnitude of X, meaning I can now have programs that are irrespective of size and volume because the LiquidX technology consolidates all of that for us. And an example of that, one of our smallest programs is by far our highest volume program. Client first upload was over 100,000 invoices. That would have taken us weeks to consolidate and prepare to an offer. With LiquidX technology, the client was able to log in, upload their invoices, digitize, and submit them for offer. And then that sent that to us within 20 or 30 seconds.
In supply chain finance and receivable space, this is more about reconciliation, where you have historically, banks and corporates looking at ways to actually getting more efficient in terms of reconciliation between POs and invoices, and making sure that data match when they get various payments for those invoices. And that's really where you have a number of applications happening around how do you match those data together, how do you extract data, so that you can be more efficient in your processes, both for actually banks and also for corporates.
So when you think about economies of scale, it puts us on par with pretty much every lead arranging bank, money center bank that has built their own technology. So it puts us at a level playing field and gives us an opportunity to really run with the bigger banks and take on transactions that historically we would have been relegated to participation at best.
I think you have the first one really is about turnaround time, right? And then you have efficiency as well. So you're finding a way where you can gain on turnaround time without having to change too many of your processes, right? If you're talking about processes that are paper intensive, historically you would have to really think about how do you remove the paper from the equation and really work on data at the onset. Whereas now, if you have a technology that allows you to extract data from paper and then run the checks directly, you don't need to change as many of your processes. And that's really what's helping both banks and corporates. And this is where you have, an improvement of the turnaround time, right? Efficiency is the first layer, really, around automation. But the key point is that you get to data. And actually, this is where you get the benefit from the AI piece. Is not only about efficiency, it's how you then are able to extract information from the data you have processed and get a better overview of the processes themselves.
For any bank that values sustainability and inclusion and helping their clients find working capital solutions and diversify their supply chain, I think is key, right? And indirectly chipping away a little bit at that pesky trade finance gap.